clearly that doesn't exist. He may need time. If he needs time, what does he do? The first thing he's done is to strike infrastructure, power grids, and so on in Ukraine, which he hasn't really done before systematically. That kind of says to me that he doesn't know what to do right now, and they are now figuring out what their next step will be. Of course, there's always, the horrific, fears that he may sort of escalate towards nuclear and so on, but so far there's been no sign of that.
Mark, the descriptions were really staggering, right? Like Russians running away on bicycles. Like, they were very specific, the description of what happened. Do we know how this is playing in Russia? How can Vladimir Putin control that narrative within Russia, which will then basically guide him to what to do next, in essence?
Well, he does still have an extraordinary amount of control over the message and the media in Russia. But you've started to see in the last few days, some of that start to break down. And some of the talk shows you've seen people actually say, this is a disaster and we should start to think about, finding a resolution, peace talks. These are, people would not have been allowed to continue speaking in the past, and here they are, speaking on national TV, being questioned, being sort of pushed back on, and being told your language isn't acceptable and so on. But it's there now, it's true. That can be a real factor. But I should repeat that so far there hasn't been any sign that Putin doesn't have support for the war.
One of the easier ways that he could respond would be simply to cut Europe off from energy. Is that now increasingly likely as a result of what happened this weekend?
I don't know that this weekend will make it more likely. It already looked almost baked in. So I don't see any reason why this would change his approach there, but it looked very, very, almost certain that he was going to continue playing with the supply and cutting it more or less to zero during the winter when it became, when you could get the best impact, the most impact.
In some ways, that leverage was really a year ago, versus now everyone's sort of prepped for that Nord Stream 0 scenario. All right, Mark, thanks a lot. We really appreciate your time. Bloomberg's Mark Champion. All right, coming up, well, the EU is set to propose mandatory power demand cuts to help curb that energy crisis. So we're going to speak with the former Director General for Energy at the European Commission. Philip Lowe is up next. This is Bloomberg.
Wall Street prepares for the latest read on inflation.
Things are moving. The news flow is extraordinary.
Will headline inflation continue to ease?
The totality of the data has been better than expected.
Very positive movement on inflation.
Instant reaction on Bloomberg surveillance.
It's a new era, and it is one of the most pressing concerns facing us.
And what it means for the Fed.
If inflation fever is breaking and economies keep softening.
They are on track, perhaps, for that soft landing.
Inflation in Focus, tomorrow on Bloomberg.
Definitely, we are going to be short supply in Europe this winter, and probably for several winters to come. I think the things that Europe can look at is first try to find energy from any source that they can, and second, affect the behavior of people, starting with their industries, because when you have to make choices, it's probably the easiest choice to make, and also because certain industries will not be able to survive in an environment where gas prices are higher and energy prices in general are higher.
That was Sharif Souki, Tellurian Executive Chairman and Founder, speaking to us in the last hour, saying the European energy crisis is here to stay. Joining us, Philip Loeb, partner at economics consultancy firm Oxera. He served as Director General for Energy at the European Commission. Wonderful to talk to you. I've heard reports that we could see this kind of tight market for Europe for years, like 2 to 3 to 4 years out. What should Brussels be deciding on? What's the right solution right now?
Well, there's no silver bullet to this challenge. Clearly, in the longer term, beyond 4 or 5 years, we can look forward to a production of electricity and of energy for heating based on renewables, with a lot more storage capacity, with a lot more nuclear as well in certain countries. But in the short term, we have to deal with the impacts both on households and on electricity producers, and they overlap, of course, because electricity is being supplied to many households too. And so governments throughout the European Union and Europe are helping households immediately by capping the bills at the retail level. But ultimately speaking, what ministers and what I think everyone in Europe is looking for now is a way of capping the wholesale price of gas and electricity. Electricity price depends on gas because it's the source of energy which is at the margin the most important for determining the final price of electricity. So in the short term, the energy ministers of Europe have already met on Friday. They've called on the Commission to come forward with new proposals, including on an energy price, on a gas price cap, including on looking at new ways of organizing the electricity market to decouple gas from the average electricity price.
Right. Okay.
And that's the way Europe is going to go.
Philip, so we're going to decouple the energy price, non-gas electricity, from the gas price, which potentially could allow a lower price and still allow investment. How, though, in the short term, if we're going to cap the price of gas as well, which is being talked about, or certainly help out consumers, how do we reduce demand? How do we reduce demand of a commodity that we have a shortage of right now, a severe shortage of?
Well, there are no easy answers, whether it's in households or in industry. The impact on the competitiveness of industry is perhaps more important for Europe in the end, whereas one can call upon households, all of us, to, for example, reduce our energy consumption and lighting and heating and in other areas. And I suspect that call for economy will be responded to positively in all countries. Mm-hmm. But we've got to do something about the price of electricity and gas for industries which depend heavily on these sources in order to remain competitive.
We're already at Nord Stream 0 in essence. The events that have happened over the weekend with Ukraine and Russia, does that make it more or less likely that there will be less gas to Europe? Can it get any worse? Or if the war ends quickly, could flows pick up?
Well, this is in the realm of speculation, of course, but we already far less dependent on Russian gas than a year ago. We're now at a level of something like 14 or 15% compared to 40% for 3 years ago. But it's the price of the gas which we need, which is still a problem, which is why in the short term, at least, capping the price of gas for electricity producers, for industry and households seems to be essential in order to defend Europe's interests. At the same time, we know that we're in a process where we hope we will not need gas in the future for our energy supplies because we have sufficient energy from renewables and nuclear.
Philip, we have a gap in the middle, and that gap could be substantial. During that gap, is European industry viable? German and many other industries are built on cheap Russian gas. Are they viable during this gap when energy prices are going to remain elevated? And if they're not viable, what happens?
Well, first of all, let's be realistic about the price of gas. Even before the Ukrainian war, we know that the demand for gas worldwide has been growing strongly because Asia is using gas instead of coal, in particular to reduce air pollution. So Europe has to face this challenge that if it wants to remain competitive, it's got to invest heavily in areas which are dependent on at the moment on gas, but where we need to turn to alternative fuels. And that's a big challenge. It is a gap, as you say. It is something where we've got to pay a lot of attention to. Member states of the European Union, countries like the UK, can help households in the short term, but in the longer term, even in the medium term, we've got to make sure that the subsidies given, including the subsidies, for example, in Germany to industry, help us along, but are combined in parallel with action to place Europe's energy mix on other things than gas.
Philip, it's been great to catch up. Really useful insight into what is happening here. We'll see the news, I suspect, trickle out over the next few hours and into tomorrow. Philip Lowe, Auxerre partner and former Director General for Energy at the European Commission. Alex, this is the problem. This isn't just an energy crisis, it is an industrial crisis.
Mm-hmm. Yes, and also someone's going to have to pay for it at the end of the day. What we're learning is that the energy transition, no matter how long it takes, someone has to foot the bill, and we can't escape it, but no one seems to be willing to do that. So that's going to be a huge reckoning at some point too.
And you wonder whether certain industries, we've talked about it already, the heavy energy consumptive industries, think about what's happening in the cement industry, etc., glass industries, ceramics industries, maybe these industries ultimately have to go somewhere else.
Yeah,
and that is a huge blow.
A huge blow, or they have to just go near a river or something to be able to get supplies more easily. I think also the question then becomes, if this is a multi-year issue, then we have a multi-year deindustrialization situation. How does that wind up affecting then growth? I don't think we've had that reckoning yet either. Nevertheless, European stocks rallying nicely today. This is Bloomberg.
Time for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. I'm Ritika Gupta. The euro surged the most in 6 months after a European Central Bank policymaker said further interest rate hikes may be needed. Traders are begging U.S. inflation data later this week could undermine the need for aggressive tightening in the U.S. The ECB raised its key rate by an unprecedented 75 basis points last week to curb the fastest pace of consumer price growth on record. Twitter is saying no to Elon Musk's latest effort to cancel his agreement to buy the social network. Twitter says Musk's latest move is, quote, invalid and wrongful. That's according to a filing today. The billionaire says the company's treatment of a whistleblower gave him another reason to walk away from the $44 billion deal. It's his third attempt to withdraw his offer. And ARK Investment Management's Kathy Wood is warning about the risks of U.S. auto debt if there's a drop in prices. In a Twitter post, she said the prevalence of ride-hailing services mean that people wouldn't prioritize paying car loans as they did back during the 2008-2009 financial crisis. The used car market is showing signs of softening after prices skyrocketed during the pandemic. And Goldman Sachs is embarking on its biggest round of job cuts since the start of the pandemic. Bloomberg has learned the Wall Street Titan plans to eliminate several hundred roles starting this month. Goldman typically revisits its headcount every year, letting go of employees based on performance and to match the bank's needs. It paused that program, though, during the pandemic. Manage your latest business flash, Alex.
All right, thanks so much, Ritika. Guy, I love that Goldman Sachs story, and I think there's a couple things we have to understand first with it. Are we looking at the normal culling of jobs into the end of the year, as Sonali was talking about earlier, or is this we don't see the deal market sustaining any kind of strong growth, therefore we have to sort of tighten our ranks?
I think it's probably a combination of both. This is normal. What came before for the previous 2 years is abnormal. This is a return to more normal processing of staff, getting an understanding of who is good, who is not, who is working, who is not, and who is making money and who is not. And that's how ultimately this process unfolds. I think you're right. There is also a change in circumstance here, and we are definitely seeing the deal story slowing down. So yeah, I just think it's a combination of both. What I'm interested in now is, if the war for talent still exists, do others follow? Are others going to be doing the same thing? Is the war for talent over? That's the signal I'm going to be taking for the next few days if others are going to be doing the same thing.
Well, it does feel that if the circumstances are correct, that this is sort of where we are now versus 2 years ago, and this is normal, then it follows that other banks should follow suit. And again, sourcing that I have, the worker had tremendous sway over the last couple of years at some of these big banks. And if that changes, how does that truly change the talent pool as well?
Yeah, it's just the other thing I would flag as well is that a lot of people have been flowing back into the office. The message has been, get yourself back in your chair, and I think that tells you where the balance of power is now shifting, and it's towards the employer, not the employee. So again, take all of these signals into account. Quick look at the markets before we head into the European close. FTSE is up quite nicely. DAX is really flying today. You're seeing some of the also stocks having a really solid day today. Europe is certainly benefiting from a combination of factors coming together. Some positive news on Ukraine. We've got a much higher euro today. Gas prices are lower. The close is next. We'll deal with the details of what is happening under the hood here. That's next. This is Bloomberg.
At that all day yesterday.
Europe is very bright green today. In fact, it's so bright I'm even struggling to read some of the percentage numbers. It's very hard to differentiate between the markets that are doing very well and just well, but let's just say everybody's having a pretty good session out there. Well, certainly most stocks are having a very good session out there. We'll get to some of the individual names in just a moment. So as we head into the close, really positive performance from Europe. You can certainly see that there. Let me just show you it from a Stoxx 600 point of view. It basically goes left to right in pretty much one direction. We've seen a little bit of a dip, but we're certainly starting to climb back up again. We're trading 427. We're up by 1.8%. Volume's actually not too bad either. So this is a decent session that is evolving here in Europe. Every single sector seems to be in positive territory as well. There you go. Even the worst performing sector, healthcare, and the more defensive names are definitely down here at the bottom. Where's everybody been hiding out recently? Healthcare, telecoms, utilities, and food and beverage. That's the bottom of the market. Top end of the market, we are flying in retail. Cars are having a good day. Banks are having a good day. Names like HSBC, but pretty much every single bank out there is having a pretty good day. Construction's doing well. The miners are doing well. Retail in particular, though, having a very good day. Basically, European governments are subsidizing this sector. They are subsidizing people's energy bills. People have a propensity to spend that money elsewhere, and that's where they're probably going to be spending it. We assume that's where they're going to be spending it. It's going to be interesting to see, as Mike says, a little later this week, to see what the retail sales numbers look like out of the States. HelloFresh bouncing back today. There were some USDA concerns about some of the meal kits that have been packed and sent out during July, but the stock seems to have come back. Thule, there's some debate on the team about how you say that name, but let's talk about bike racks and roof boxes and all that other paraphernalia you attach to your cars. That seems to be fading a little bit at the moment. Bit of a profit warning coming out of this company. Maybe we're biking less, maybe we're driving to holidays less, maybe we are flying more. But basically, apparently, we don't need quite as many bike racks, or maybe we've already got them, or we are done with roof boxes. Certainly, the staycation has been a big boost for the roof box, judging by the traffic going up and down the A303 here in the UK. And then we come to Uniper. It is up by 3.1% today. We're going to get the news over the next kind of day or so as to what is happening with the energy story. But today, Alex, basically, Europe is rallying on potentially better news coming out of Ukraine, a significant drop in energy prices. We've got a stronger euro on the back of that. We've certainly got stronger stocks, and the utilities are doing quite well.
I know you set me up really well for this intro, but I have to go back to the HelloFresh situation because that might have made my day. Because what company is that? I feel like we can go for a while on this one. Okay.
It's actually an accurate description in some ways.
Okay, moving on. I don't know what to say about that. HelloFresh. I love it. Okay, Guy was setting us up, though, to talk about the stronger euro, so let's do that. Euro up 6-month high against the dollar. We know the ECBs are hawks. That is underscored today, earlier by ECB Executive Board member Isabel Schnabel.
Based on our current assessment, over the Governing Council's next several meetings, we expect to raise interest rates further towards levels that will ensure the timely return of inflation to our 2% medium-term target.
Joining us now, Mark Anderson, co-head of Global Asset Allocation for UBS Wealth Management. Mark, how do you understand the euro move over the last 2 days, right? I feel like we have multiple choice. There's positioning, there is a sea change potentially in Ukraine, there's the hawkish talk from the ECB. What's the explanation?
I'd certainly say that the 75 basis points hike we got from ECB last week, along with this very, very hawkish notion that we're going to see over several meetings hikes again, and if we're not going to get 50, then probably back into the 75 basis point camp. So ECB has basically joined the Fed in this notion that we're going to have to kill, first of all, inflation expectations, bringing them down, but also demand to a point where we're going to see kind of inflation expectations moving solidly down. And that's obviously helpful as well here for the euro that staged a little bit of a recovery, which frankly speaking we think is a bit temporary. We still think that there's a bit more to go for the dollar, and the Fed will lift rates higher than the ECB will manage to do.
Mark, if we get good news out of Europe, how much of a coiled spring are we going to see unwinding? Are we going to see a lot of money flooding back into Europe? How much of a I keep mixing my metaphor, how much of a hair trigger are we on? Any good news, how much could Europe go up by?
I'd certainly say that the recession is what everybody's talking about in Europe. So any sort of indication that we're not going to get a recession certainly would be a strong positive. We see, broad European equities trading on average at around 10 times earnings, slightly above, with expectations for earnings to drop on the back of a recession. So if we get out of that kind of corner, I'd certainly say there is significant upside to European equities. But maybe before we do get too bullish, I'd say even if with natural gas prices down over the last few sessions here, I'd say that we're still looking at an overall kind of gas bill and electricity bill in Europe that is going up, something that will be hurting sort of the European economy, a stronger euro, a very, very aggressive ECB as well these days. So before we get ourselves wound up too much, I still say that there are some headwinds we'll be facing over the next couple of quarters here.
So, Mark, do you sell any RIPs then for equities?
If I'd be selling what, sorry?
You sell the RIPs on equities. You just sell any strength at this point?
No, we are not. We're probably positioning slightly differently. So even if it's certainly a day for some of those more kind of discretionary cyclical stocks out there, we are having a little bit of a defensive tilt these days. So we'd probably be looking more at the things at the lower ranking today. So it's more the healthcare, the consumer staples into what we think is going to be a recession towards the end of the year in Europe. We still love some of our energy exposure. We think that oil prices are moving higher, even despite this price cap announcement from G7 that we saw out last week. Energy companies trading very, very cheaply still in our view. So that's where we are looking as well as value into this kind of environment of high interest rates and still kind of an attractive valuation to some of the growth stocks out there. So that's where we're looking to add, but broad markets we have more or less flat over the next 6 to 12 months.
Mark, when you talk to your clients, how are you talking to them about this positioning? Is it an absolute trade or a relative trade? Is that a benchmark trade, or do you think they're going to be able to actually make money in some of those positions?
So we certainly have it kind of relatively positioned in our portfolio, but we think in absolute terms a number of these trades are going to be up as well. So if we look at something like kind of a broad S&P index, we have mid of next year kind of 4,200 targets, so that's mildly up from where we are today. So not kind of a lot of money to be made on benchmark levels. If we look into something like the energy names that we're having in there, so even just at current oil price levels, they're still looking at extraordinarily attractive valuation, good earnings flow, but on top, kind of from today's 94, 95 oil level on Brent in dollars, we're forecasting 110 at the end of the year, 125 by March of next year. So kind of a significant upside on earnings. So that's in absolute terms also, Guy, and Alex, certainly something that we'd recommend absolute investors as well.
Mark, what if the European Commission comes after oil companies in terms of using their profits to help pay for the rising prices? How do you think about energy companies then?
We certainly think that there is a little bit of a risk, and this is also not something new. So it's something we've been talking about for months and months. So to some extent, it's already, I'd say, priced into current valuations again that are very attractive. So I do think a little bit of a negative headline risk, but also one of the reasons that I think energy companies have not fulfilled kind of their full potential. And I think we obviously also talk about price caps, so everything in a way appears to be very negative on a headline news these last couple of days. But we think if anything, there is a risk we're going to lose a couple of million barrels of oil supply, first of all, from Russia potentially needing to reroute more of their oil supplies into Asia, so towards China and India. And at the same point in time, we shouldn't be forgetting we've had this 6 months of an additional 1 million barrels from strategic reserves being supplied, in particular from the US over the last month. That's going to end in November. So we're going to see a lot less supply in our view and demand coming up once we're going to get China out of this very uncomfortable COVID situation that they're still in at the moment.
Mark, how are you thinking about QT right now to completely change direction? It's underway in a big way in the United States. In theory, the Bank of England is going to be conducting it as well. There's some talk that the ECB may go down that road as well. What impact will that have, do you think, on people's portfolios?
We've certainly done a lot of analysis on this QT question, and we don't think it's the exact opposite of QE. So we do think that there is a clear negative. So on one hand side, we are certainly seeing is providing a degree of upward pressure on yields relative to fundamentals. So to some extent the opposite of QE. But there's a little bit of a liquidity draw here in the market as well, which we do think is negative for risk assets. And also one of the reasons that if we were to line up the reason that we don't think that we're going to get a continuation of kind of the last few sessions bullish markets is not only QT, but it's broadly speaking very aggressive central banks looking to tighten financial conditions. It's earnings coming down. It's a relatively, I wouldn't say certain European recession, but certainly a significant slowdown from current levels still. So I think there are a lot of reasons to believe that QT, along with some of these other factors, are going to put a little bit of a dent on what's otherwise a great day that we obviously all enjoying here.
Yep, bright green. Mark, great to catch up. Always appreciate your input. Thank you very much indeed. Mark Anderson of UBS Wealth Management, thank you very much. Little tick lower during the auction for European equity markets. We are finishing at or very near session highs. These are the final numbers. As Mark was just saying, some very positive numbers being posted by European bourses today. FTSE, DAX and CAC all roaring higher. The DAX in Germany up by 2.4%, but it has been the big underperformer. So bouncing back maybe a little bit more. That's where we sit in terms of the close. What are we going to do next? We've got some great coverage coming up. We'll continue to digest and dissect what we've learned today. Alex and I will be doing that on the cable show. We'll do that on Bloomberg Radio at 5 p.m. London. That's 12 p.m. over in New York. You will be able to find us on DAB Digital Radio, also on the terminal, all of your Bloomberg devices, the podcasts available later on, Spotify and iTunes.
All right, coming up, Guy, another UK bank holiday, I should say, for the Queen's funeral is maybe enough to tip the economy into recession. Now, that's according to analysts over at Nomura and Deutsche Bank. So we're going to get the take from Samuel Toombs, Pantheon Macroeconomics Chief UK Economist. This is Bloomberg.
Keeping you up to date with news from around the world, here's the first word. I'm Rishika Gupta. Russia hit power plants deep behind Ukrainian lines today, causing blackouts across the northeast of the country. Ukraine says more than 30 settlements have suffered Russian missile and airstrikes over the past day. At least 2 power plants were reportedly hit with precision rockets. Meanwhile, Ukrainian troops are continuing to advance in an offensive that has reversed months of Moscow's advances. The European Union is unveiling plans to help homes and businesses across the continent survive an unprecedented energy crunch. The European Commission will propose this week power demand reduction targets and plans to rechannel part of energy companies' profits. That is according to a draft regulation seen by Bloomberg News. And Goldman Sachs is embarking on its biggest round of job cuts since the start of the pandemic. Bloomberg has learned the Wall Street Titan plans to eliminate several hundred roles starting this month. Goldman typically revisits its headcount every year, letting go of employees based on performance and to match the bank's needs. It had paused that program, though, during the pandemic. And King Charles III is vowing to uphold parliamentary democracy and follow what he called the selfless duty of his mother, Queen Elizabeth II. Addressing Parliament today, the King said he felt, quote, the weight of history surround him. Charles is now in Scotland, where he led a procession carrying the Queen's coffin through Edinburgh. The Queen will be laid to rest 1 week from today. Global News, 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg. Guy.
Rishika, thank you very much indeed. So the UK economy is recovering a little more slowly than expected from the slump that was triggered by that extra public holiday that we had back in June. And some economists are now warning that another holiday for Queen Elizabeth's funeral later this month could tip the economy into a recession. It's going to be next Monday. Here to share his perspective on all of this, Samuel Toombs, Pantheon Macroeconomics Chief UK Economist. Samuel, what impact do you think this will have? What impact will the UK mourning its Queen have on the data, do you think?
Well, of course, we don't have a clear past precedent here to go on, but perhaps we can get a steer from the Jubilee celebrations in June, when, of course, there was that extra public holiday in June. And now that we have July data, we can see quite clearly that there was a 0.2 percentage point hit to the level of GDP in June from that extra public holiday. So that's probably a reasonable starting point. But I think there are some reasons to think we could see an even bigger hit in September. Of course, everyone was celebrating then, and the hospitality and tourism sector clearly benefited in June from that. Whereas this time around, perhaps people will be much more somber and less likely to visit those sorts of venues. In addition, there may well be more business closures this time around than in June as well. For instance, restaurants and shops may close temporarily whilst the funeral is going ahead. So we could see a bigger hit than that. And if we're getting to a hit of more like 0.5% September GDP, then that certainly could be enough to cause a technical recession of 2 quarters of falling GDP.
So, and then weirdly enough, you have to wonder, does that then help inflation, put a little teeny tiny cap on it in some respect? I want to just point out some verbiage here from Andrew Sentence. He spoke earlier about this double-digit high inflation. Cambridge senior economic advisor, Andrew Sentence, here's part of what he had to say.
We can't sustain double-digit house price inflation, so if higher mortgage rates bring a bit more realism into the housing market and put a dampener on house price increases, that's not necessarily a bad thing, and it actually makes it easier for first-time buyers to get on the housing ladder.
What's your take? Have we seen the peak? Is it going to get worse?
House price inflation, as Andrew was referring to there, I think we are pretty close to the peak. It's very clear looking at timely demand indicators now that the new buyers are being put off by much higher mortgage rates. Yes, of course, a slowdown in house price growth is going to help those first-time buyers, but we're seeing a massive hit to those monthly mortgage repayments from the sharp rise in mortgage rates. That's primarily what's driving this housing market slowdown. So I think what we will see during the winter is a further decline in mortgage approvals, a further decline in housing market activity, and a very subdued market towards the end of this year. So not really much good news there for first-time buyers, I'm afraid.
What impact will the energy price cap have, Samuel? I was reading some of the things you were saying last week, talking about the fact that this could benefit the government because ultimately it will cap inflation. But I'm wondering more broadly what your thoughts are on what this is going to do in terms of the ability of the UK economy to survive a recession or not have a recession, or at least a deep one this winter.
So I think the energy price cap means that we're very close to the peak rate of inflation in the UK now. I think it may get up to nearly 11% in October, but from 10% or so at the moment. But then it should fall quite sharply into 2023. There are actually some quite encouraging signs now at the start of the inflation pipeline. Of course, we've seen oil prices fall quite sharply in the last few weeks, but other commodity prices have been falling too. Shipping costs are down, and retailers and manufacturers are saying that they have far too much stock on hand now in relation to the level of demand that they're seeing. So I think there will be some significant goods deflation as we go into 2022, and that will help to bring down the headline inflation rate quite quickly as we go through 2023. And I think actually by the end of next year, we could be very close to being back to that 2% target. So that's good news. And I think the fact that consumers and hopefully businesses soon too will have this certainty now over the future energy prices going forwards, we will see a bit of a bounce back in confidence in the fourth quarter of this year, and that could be enough to certainly avoid a winter recession. When we model the outlook for households' real disposable incomes, we now see a recovery over the next few quarters because although that price cap is increasing, the government has actually provided additional grants as well to help.
Let me flip it though real quick. If there's a price cap, can't I just go out and spend more and buy stuff, and that actually moves inflation higher?
Well, really what we're seeing is, households being protected from a big rise in energy prices. So they're not going to have any more money really now or in the fourth quarter than they have right now. I don't see this as being a sort of demand stimulus to the economy. It's just preventing a very large shock hitting them in the fourth quarter. And of course, many households are now facing higher mortgage repayments when they refinance as well. So there's still plenty of headwinds to the potential recovery going forwards. I think it will be very modest growth that we start to see as we go into 2023 in the economy. And certainly no runaway growth that might fuel inflation.
All right, Samuel. Okay, there's some positive signs maybe. Samuel Toombs, Pantheon Macroeconomics Chief UK Economist. Thank you very much. We appreciate your time. This is Bloomberg. Our U.S. stocks holding onto their gains here. The S&P up by about 0.9%. Abigail Doolittle is tracking those moves for us. Abigail?
Well, Alex, it really is an impressive rally over the last few days. We have 4 up days in a row, the longest winning streak for the S&P 500 going back to July 7th. So it really does, again, continue to beg the question of whether or not this is some sort of rebound rally with legs. In other words, will it be a bear market rally, another one, or could it actually even be a real bottom? We will know more as time goes on. Technically, it's still still a bit cautious, but nonetheless, you can see this 5% gain is really pretty impressive. Now, a big driver of it, of course, is Apple. Apple having another big up day for a second day, up about 5% over the last 2 days. The iPhone 14, the pre-order data is very strong. A lot of Pro phones being ordered. That higher price point plus holding on to pricing despite the inflationary situation is good, not just for Apple, but also for some of those Apple suppliers such as Broadcom. We also have crude oil trading higher, up about 2%, so it is an overall risk asset rally. The driver could be this weak dollar, because that was, of course, the case last week. We had the S&P 500 down 3 weeks in a row. Last week, an up week. That, of course, as the dollar dropped, the dollar had been higher in those other 3 weeks. So that inverse relationship, let's take a look at it, in fact, because it's pretty powerful from a macro standpoint. The dollar for some period of time in 2021 had basically been flat, but as it started to climb, you can see that is one of the reasons that the S&P 500 went flat initially into a range and then down as the Bloomberg Dollar Index continues to hit record highs. But coming off of that high, and here we see this little rally, guys. So the dollar is a critical driver, a critical factor to watch relative to whether or not this stock rally might just continue.
Yep. So our question of the day, is the dollar done? Mixed opinions, certainly, throughout this show. Abigail, thank you very much indeed. So what comes up in the next 24 hours? Plenty to think about. Alex, today the president speaks on the bipartisan infrastructure bill. King Charles III holds a vigil at St. Giles Cathedral. We've got the remembrance service, obviously something that we've watched very carefully this afternoon. We've got Oracle earnings as well after the bell.
And tomorrow we've been talking about is U.S. CPI data for August, plus the Twitter whistleblower Senate hearing. That's going to be obviously fascinating. Definitely watch your Twitter feed from that. And opening arguments for Nikola founder trial will be happening, and also the Queen's coffin will be traveling to Buckingham Palace. And Didi comes out with earnings as well. So lots to watch on the geopolitical front, their earnings front, as well as the economic front. That wraps it up for me and Guy here on television. Coming up, Leon Panetta, former U.S. Secretary of Defense, will be joining Balance of Power with David Weston on Bloomberg Television and radio. And Guy and I will also be heading to radio. Tune in to us for Bloomberg's The Cable with Guy and myself. That's coming up at the top of the hour, 12 p.m. in New York. It's 5 p.m. in London, live on Bloomberg DAB Digital Radio. We'll go through all the top headlines from the day from the U.S. as well as the U.K. Happy Monday, everybody. This is Bloomberg.
This is Bloomberg. From the world of politics.
This will end, I believe, early next year. The Ukrainians are going to push the Russians back to the 23 February line before the end of this year, I believe.
To the world of business.
I don't see reasons to believe that the dollar is on the verge of softening against other major currencies.
This is Balance of Power with David Weston.
From Bloomberg World Headquarters in New York to our TV and radio audiences worldwide, welcome to Balance of Power. Over the weekend, we received word of real progress apparently being made by Ukrainian forces in the northeastern part of the country with Russian troops in retreat, something that has been confirmed more or less by the Kremlin. For the view from Washington now, we turn to our Washington correspondent, Anne-Marie Horduran. So, Anne-Marie, it's hard to know exactly what's going on over there, but what does this say about the White House strategy, where it has been and where it is going?
Well, with the White House sending over billions of dollars, U.S. Congress as well, it's likely that the White House's request for more money, that is still going to be a top ticket item that you're going to see a lot of bipartisan support for. And I think this just shows that Ukraine is able to fight with the weapons given from the United States and allies as well. It also comes at a really difficult moment for Europe as they go into these winter months and you see Putin turning off the taps in terms of natural gas. We know it's going to be very difficult for Europe, but this does show that their support for Ukraine is working. We also have the White House, though, David, condemning what we saw right after, which was that, yes, Russia said they are going to regroup. That was a very rare admission because of the Ukrainians really pushing them back. But we did see them cause a lot of havoc when it comes to blackouts and electricity in Ukraine. And, you know, a really big question is if this is what the situation is now and you have the Russian military very much so stretched on the eastern and southern part of Ukraine, does this mean that Putin will turn to other forms, long-range missiles? Will he start to be a little bit more aggressive in Ukraine? And that is why you have, just in the last 2 hours, Ukrainians' advisor for President Zelensky telling Maria Tadeo and Guy Johnson that more of this type of weapons and material and support is going to be needed.
Okay, Anne-Marie, thank you so much for that report today. That's Bloomberg's Anne-Marie Horduran reporting from Washington. We turn now to Leon Panetta. He's chairman of the Panetta Institute for Public Policy. Mr. Panetta served as Secretary of Defense and Director of the CIA under President Obama, and he also was White House Chief of Staff for President Clinton. Mr. Secretary, thank you so much for being back with us. You've been there, whether it was at the CIA or the Defense Department, interpreting reports such as we're getting out of Ukraine right now, where we think about Clausewitz and the fog of war. How significant do you think this is from what you've heard?
I think it's a very significant moment. I would say it's both pivotal and dangerous. It's pivotal because to have Ukraine conducting a strong offensive that's working is incredibly important to putting real pressure on both Putin and the Russians. And that takes me to the dangerous point, which is that it's dangerous because Putin, if he's boxed in, obviously will have to strike back. There are Russians who are criticizing him now in Moscow because of this retreat that's taken place. And the real issue is whether Putin now strikes back. He already has hit back on the infrastructure, whether he resorts to more, including the possibility of battlefield nuclear. All of that creates a dangerous moment here. But I think this is a very critical moment in which the Ukrainians have to consolidate their advances, hold that territory, and make clear that they are without question a force to be dealt with.
So you really went to the essence of it. What is possible within his capability for President Putin to do here at this point? Does he have the resources in terms of troops and tanks and artillery to go back in and reclaim this territory? Or might he have to resort to other things, such as you mentioned, tactical nuclear or even chemical weapons?
Well, there's no question that the impact of this offensive tells us how the Russians have largely been depleted in terms of both their forces and their equipment. this offensive has moved very quickly. The Russians are retreating quickly. It's not something you can turn around on a dime. And even though they're retreating for the purpose of regrouping, I think it tells us a lot about the ultimate weakness in the Russian force that I think indicates that if the Ukrainians can continue this offensive, get the assistance that the United States needs to continue to provide, not only from the United States, but from NATO, this could be a moment in time when we will look back and say this was the turning point in terms of the war in Ukraine.
Mr. Secretary, do you have a sense of what is the most important assistance we either are providing or could provide? And we tend to think of in terms of weaponry, like those HIMARS says some things, but it also may be intelligence, something you know terribly well.
Well, there's no question that I think intelligence sharing is critical, particularly when you're engaged in an offensive. You've got to know where the enemy is, and you have to know what is the state of their force, and whether or not, as you proceed with the offensive, that you can, in fact, not only gain territory, but retain that territory. So intelligence and intelligence sharing is going to be critical. In addition to that, I think the ability to have long-range missile capability, to be able to strike at the Russians as they retreat, keep the pressure on. This is a moment when you cannot kind of sit back and not continue to push forward. So I would say there's two important things for the Ukrainians to do at this moment. One, consolidate the gains that have been made, and secondly, continue to put pressure on the Russians.
It's early going, and there's a long way to go without a doubt. At the same time, it may not be too early to anticipate how does this end. Let me give you a hypothetical, for example. If, in fact, the Russians got pushed back to where they were before February 24, is that a time for possible negotiation?
The key has always been what will Putin ultimately decide? And the key to Putin is to put leverage on Putin. You've got to show him that there is a continuing price to be paid for remaining in Ukraine. And that's what the Ukrainians are doing. So now the issue becomes, does Putin decide that this is a moment to declare a ceasefire and recognize that that this is not a war that Putin can win? And so he's got to negotiate an off-ramp at this point. Or does Putin dig in because he's now in a box and continue to strike back? That is the fundamental issue that will decide where we go from here.
But I would think, Mr. Secretary, that in fact, let's assume, and this is a huge assumption, that Mr. Putin was interested in a ceasefire. If I were President Zelensky, I'd say, well, wait a second. We have a ceasefire that gives you, Russia, an opportunity to regroup. What guarantees you're not just going to do it again 6 months from now, a year from now?
Well, I think that's what President Zelensky has to decide as head of Ukraine. Whether or not a ceasefire can pay off in trying to consolidate the wins that the Ukrainians have made and try to hopefully be able to emerge into an approach that moves us away from this constant warfare, or whether or not the Ukrainians are going to continue to put pressure on Russia and push them out of Ukraine, in which event we're dealing with a much longer war. That's a fundamental decision, and that decision rests with President Zelensky.
Finally, Mr. Chairman, let me turn to a very different subject, and that is the passing of Queen Elizabeth II and the succession of Charles III as king. As I said, you served, among other things, as White House Chief of Staff for President Clinton. Give us your perspective on, as President Biden goes over this coming weekend to attend the funeral, the significance of that for the Biden presidency. What do you do when you're in the White House trying to really handle something like that the correct way for the United States?
I think the most important thing at this point is to make clear that the United States and Great Britain are strong allies. And I'm glad that President Biden is going to go to the funeral. I think it'll be an opportunity to meet with the king, to meet with other officials there, and to renew the strength of that alliance. It is very important right now that we maintain stability in the relationship and ensure that even now with the king, that we can build a very strong relationship with Great Britain that can not only help us in terms of promoting peace and dealing with Russia, but also can bring the European community together as we have in unity. This is a moment in time where I think the United States and our allies, particularly in Europe and particularly with Great Britain, this is a moment where that kind of unity can make a real difference as far as how we deal with our adversaries.
Mr. Secretary, thank you so much for being with us. That's very, very helpful. That's Leon Panetta. He's chairman of the Panetta Institute for Public Policy. Coming up, as we wait for the U.S. CPI numbers out tomorrow morning, we're getting a sense of where the U.S. economy is and how it compares with Europe and others with Megan Green of Brown University's Watson Institute. This is Balance of Power on Bloomberg Television and Radio. This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. To keep you up to date with news from all around the world, we turn now to Mark Crumpton here with the first word.
David, thank you. Ukraine's lightning offensive triggering a collapse of some Russian defenses as Kyiv continued a rapid advance in the Kharkiv region over the weekend. The UK Ministry of Defense says Russia has likely ordered the withdrawal of some of its troops in the region. Ukraine's top commander says his forces have returned more than 1,100 square miles of lost territory to Ukrainian control since the beginning of September. Meantime, Russia struck power plants vowing to counter the Ukraine offensive. Ukraine's general staff says more than 30 settlements suffered Russian missile and airstrikes over the past day. Kharkiv, one of the least two power plants struck by rockets, had power restored, only to lose it again later today after being repeatedly shelled. That's according to the city's mayor. Bloomberg has learned Germany has made a preliminary decision to buy Israel's Arrow 3 air defense system instead of a viral product manufactured by Lockheed Martin. The Arrow 3 interceptor, manufactured by Israel Aerospace Industries, could cost around 2 billion euros. That's according to German media reports. Germany is working to modernize its armed forces following Russia's invasion of Ukraine. In Vienna, the International Atomic Monitors are discussing the standoff with Iran that's dragged efforts to revive a landmark agreement to curtail that country's nuclear program. The International Atomic Energy Agency's probe into Iran's past nuclear activities has taken center stage in talks to resuscitate that 2015 deal. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg.
Thank you so much, Mark. Well, tomorrow we get CPI numbers for the United States, and everybody's looking forward to them to figure out what that means about what the Federal Reserve might do next week. Take us through the state of the U.S. economy, and by the way, how it compares with places like Europe. Welcome now Megan Green, Senior Fellow at Brown University's Watson Institute, and also Chief Economist at the Kroll Institute. Megan, great to have you back with us. First of all, CPI. Are we going to see inflation coming down, and if so, how much?
Well, I think we'll see headline inflation coming down thanks to lower gas prices. But in terms of core inflation, we might see it tick up very moderately. I actually think the risks are on the downside.